I start with the introduction of our guest for today. A small disclaimer like whatever we would be discussing in today's session will be purely educational. And if any name of any companies prop up during the conversation so as to illustrate the framework or thought process, that should not be construed by the attendees as a buy, sell, or hold recommendation. That would be purely an responsible for any financial losses. Please consult your financial advisor in case you want to make any investment decisions. So, guys, let me take a moment to introduce our guest for today. We have Venkatesh Jayaraman with us. He's a personal finance enthusiast, an individual investor, and a productivity and time management strategist. So he's very passionate about sharing his knowledge, learnings, and experience with others, thus helping others grow in their journey. So today also we'll be having many questions around his journey and his learnings, and that is surely going to benefit us all. So he has been doing this on Twitter since the year 2018, and in the last 5 years he have shared considerable number of good knowledge, especially through his blogs. Last year, he has launched a website that goes by the name of mysuccessproject.in. On the website, he has published blogs on topics around personal finance, stock investing, and productivity. Till now, he has posted more than 60 plus blogs on his website, and those are available for all of you. And surely you can visit in your free time. That is going to be really helpful and knowledgeable for you. So, and a very interesting thing, like he last month released a book that goes by the name of No to Say No, something that most of us struggle with, and I would say personally I also struggle with this at times. So, would be knowing what was the thought process behind this and how we can improve on this front. So, as far as stock market is concerned, he's into market since 2008. In today's space, he'll be sharing his investment thought process from his last 15 years of journey. So he'll be covering like how he picks stocks, approach to stock analysis, and insights into his thought process and framework. He would also be touching upon the very important concept of risk management. And there are very many good questions lined up with us, and so we'll be asking one by one. A very warm welcome, Venkatesh. Any opening note from your side so as to set a backdrop for the session?
Sure, Prince. Can you just confirm that I'm audible?
Yeah, yeah, loud and clear.
Okay, thank you. So that was a very nice introduction, Prince. Thank you very much. Thank you for inviting me as your speaker to your spaces. I have been seeing your interest in conducting Twitter spaces on topics around investing. I am really impressed by your passion. I really appreciate your initiatives. Good luck on this. And all friends who are in the spaces, I heard from friends that many had expressed interest to have me as a speaker. My wholehearted thanks for all your interest, and thanks to all the listeners who are in the space for your time and interest today. As said, today's topic will be on stock investing and not on personal finance. I will try to give the best response for all the queries raised by Mr. Prince. Though he has already given a disclaimer, I also need to repeat that I would not be discussing any stock names or sectors, but if I take names to drive idea, kindly note it's not a recommendation of any kind. And also to explain some idea, I may take numbers as an example. These are completely random numbers, so do not focus on whether the number is low, high, or unrealistic. And also let me say that each one of us have our own investment beliefs, strategies, risk appetite, and purpose of investing. And whatever I discuss today is from my journey. So not everything what I discuss may match your expectations. So use the session today as a knowledge gathering session where you can learn something to implement these ideas into your reality or framework. If suppose something is contradicting your existing belief or you find it difficult to accept, just ignore the idea and move on. And most of that, whatever I discussed today, could have been well covered in my earlier blogs or videos. So I would be referring them for you to listen or read for an in-depth response. I may also refer to external literature for a better understanding. And also, as a general heads up, I'm on a business trip and I'm staying in the guest house. So, should there be anyone at the doors, I may go on mute for not more than 2 minutes. Over to Prince.
Yeah, great, Venkatesh. And like before I ask the first question, I would tell my attendees that Venkatesh is one person who I know is very focused, and he always believes in doing his homework before saying or publishing any blog. So he's a very hard worker on that sense, and he believes like he shouldn't be giving any vague answer, or maybe not in the sense vague, but again he is a kind of person who believes like if somebody is asking him something, that the question and the answer both should be in sync, and the answer should cover all the aspects in a holistical manner. So thank you for that, Venkatesh, and look forward to this session. And my first question is like how your investment journey started and from how it started. And I mean, obviously we would love and appreciate if you tell us about the evolution as an investor. Yeah, over to you.
Thank you, Prince. So, to talk about my journey, I have been observing the stock market since my school days. So, my father was investing into stocks in the group companies where he was working. He was not a trader but an investor, but he didn't know anything about technicals or fundamentals what we are talking today. He only invested purely based on the trust what he had on his employer. So my interest was I used to check the stock quotes once in a week in a newspaper. So that was the only involvement in that age. So fast forward a few years, I started earning, but even after earning for many years, I was not into stock markets. Then a little later part in my career, in my workplace, I used to see friends who were doing daily trading. I clarify the word trading. So they used to invest something in the morning, and by evening they used to have a few hundred rupees of profits every day. So whatever stock name they put, they used to make money, hundreds of thousands. Today we are seeing in social media screenshots of profits and kind of things, but that time I have seen a live screen of my friends making profits. Very easily they used to have a minimum 5% gain. So this was all happening in the second half of the year 2007. So I felt I was missing the show and I should also benefit from this, and I decided to invest in the markets. That timing coincided with the famous power sector IPO that came out in Jan 2008, and I also applied for that IPO, no doubt. And in the right words, I entered the market out of greed and fear of missing out bias. Many of you could know what happened of the whole of the year 2008. There was a complete meltdown in the global markets and Indian markets. So by 2009 quarter one, I lost my mental and financial strength to continue in the market further. So I quit the market almost completely in the intermediate period. Like the Satyam scam broke in January 2009 when the Indian market hit all-time low, and right before the election results came in April 2009. In the intermediate period, I completely quit the market. And what happened was immediately after the results, the market started galloping like a racehorse. In fact, the first day of the election result came, the Indian markets hit the upper circuit and closed within a couple of seconds or minutes. So what happened was I was there in the complete period of pain, but I happened to exit the market when there were better days to come. So from then on till 2012, I was just merely observer, watching the stock quotes, reading blogs and articles, and so on. During one such read, I came across an article in the Value Research website where they were talking about the influence of Benjamin Graham on Warren Buffett and how Warren Buffett reads his book every year. And the gist of that article was if you are into do investing, these two books, that is Security Analysis and Intelligent Investor, are a must to read. So I should say that this was the defining moment in my investing life. So I did read those two books and started a new journey from here. So to be precise, I took nearly 3 to 4 months to understand the book, not read the book, to understand the book properly. So each chapter I used to read 2 to 3 times. So initially I thought like if I read these two books, I would become a great investor. only to realize later that the learnings are forever. So one book led to the other. Like then I started reading books by Philip Fisher, then books by Peter Lynch. Then I understood that it is more important to understand the market in Indian reality. So I started reading books by the Indian authors. So on, I nearly read some 30 to 40 books about stock investing. So I did not stop with reading, but implementation also. So the implementation gave me more lessons. So whatever I learned, I tried to bring in a framework that actually best suited me. So with this framework, I rebooted my second innings somewhere in 2015. The framework has been continuously evolving from then on, even till date. So I need to make a special mention here. Like even as I was creating the framework, the thought process of Mr. Ramdev Agarwal, Sri Parag Parik, Mr. Shankar Narain, Mr. Saurabh Mukherjee, and Mr. Rajiv Thakkar had a profound influence on my thoughts. These are all through their media interviews, webinars, books, which was talking about their investment style. Though in the period between 2012 to 15, I was primarily reading, learning, creating framework, all that. I was still invested at a very low level of allocation. Basically, I was trying to experiment without any serious return expectations. As Prince pointed out, in 2018, I was more active on social media to share my learnings. But even before that, I am in social media, but more on a listening or a silent mode, just trying to get the gyan from my gurus. So this is a very brief about my journey. Over to Prince.
That's great, Venkatesh. So, Venkatesh, tell us more about like your investment thought process and what is central to it, from generating ideas to making an investment. How it goes for you?
Okay, so this shall be a bit longer response. So I will try to categorize into three stages. So the entire thing happens in three stages. Right from the beginning of getting an idea till investment, it happens in three stages. The first one is getting a universe of stocks. That is the first stage. I try to get a list of stock names. This is basically fishing for ideas. My sources are: I am a subscriber of the Wealth Insight magazine of Value Research. So there they talk about different stocks, or they have attractive blue chips, attractive dividend yield. So they have different categories of filters where they run and put the stock names. So that is one place. Then I do refer the holdings of selected mutual funds run by some fund managers and famous investors. And some stock names hit the news for good or bad reasons. So that also go to my list. Occasionally, based on some parameters, some screeners come into my mind, like okay, such and such percentage of ROCE or ROE or whatever. I run that parameter, and if that is some interesting name comes up, that also gets added. So this is only the starting point. So just because I pick up a name from the mutual fund, I really do not jump and invest into it immediately. So that's a separate process. This is only just to gather the names, and I do it with no dedicated time. As and when it happens, I randomly make the list. So this is the first stage, how the ideas are generated. Now once I get some 10 or 15 such stock names, I go to the second stage of verifying the 10-year financial statements. So I pick up the 10-year financial statement. It could be either through the screener website or the company annual report. Most of the annual reports have a beautiful 10-year snapshot in their annual report in the beginning or the end. So that will be the reference. So at max, I spend 1 hour per idea. So what I basically check is the company making profits? So is their ROE, return on equity, greater than 15%? What are the debt levels? I am not comfortable with stocks with very high debt levels. So those go out of my list. Then what has been the growth in the last, growth in terms of revenue and profits? And what are the profitability ratios? And the number of companies. So I'm more favorite or interested in a sector where the number of companies are very less. That is because of my belief that the competition would be less. So, but there are contra examples like telecom where you have two or three companies, but there's intense competition. But in general, lesser the number of companies in that sector, that gives some interest on that company. So when I finish this 10-year financial statement analysis, I have to drop a few names get dropped through these filters. So usually 2 to 3 ideas get through. Then comes the most important thing. Yeah, I'll just make a small note. I have written a blog on how to analyze the 10-year financial statements, and I have put it on my Twitter page. So if you want to read it entirely how I do this 10-year financial statement analysis and gather insights, please read my blog, check my Twitter page, and you will get a link to that blog page. Okay, now comes the important stage, that is the rigorous analysis. Now I told out of 10 I have 2 to 3 ideas. Those 2 to 3 ideas will be subject to a rigorous analysis in line with my framework, what I talked in my previous question. I told you right from 2015, I have been developing a kind of framework based on my learnings, and that framework I'll be subjecting the stock to a rigorous analysis. It is a multi-step framework. The minute details of the framework has been well captured in my 4 hour long video in my YouTube channel. That playlist is called as How to Analyze a Stock. It's a 15-part video. Do spend some 4 hours if you're interested in that, and you'll get to know the complete details. However, for the sake of this discussion in spaces, I'll just put a brief of how I take through the framework. So for that company, or those 2 or 3 company, and I analyze the business. How's that? What is the product? How they make money? What is the level of competition? How many companies? Who has more market share? Whether the company what I analyze has more market share, or does the competitor have, or who is more dominant? Whether the company which I want to invest or the competitor. So this kind of business analysis, who has pricing power, this kind of business analysis comes as the first step. Then comes the management capability and integrity. These are two different things. Integrity is to do with honesty, and capability is to do with what the management can succeed, or a growth mindset. A capability brings in growth in the revenues and profits. So this is more of qualitative nature, which maybe we can talk more about this in the subsequent part of the session. So this analysis, after the second stage of management analysis, the third is about the growth. That is very important. So what has been the past growth? So that is obvious from the financial statements. And what is the anticipated future growth, and how long that growth can happen, and what can disrupt this growth? So this analysis happens at the third step. Then comes the fundamental analysis, which is nothing but your horizontal analysis, vertical analysis, the financial statement analysis, those kind of things. I do it in a slight depth where I will be able to gather the inferences on the management strategy and future ambitions. I'll definitely explain the later part of the session. So let us move to the next step. So after the fundamental analysis is over, then comes the valuation. So there are many valuation tools. So the previous steps will help me to decide which valuation tool will be ideal for this situation or the stock. So this 5 or 6 steps is what essentially is my framework, and it's a rigorous framework. I mean, it's a rigorous analysis, and the sequence is more important because I never touch valuation till I finish the other part of the analysis. Because most common approach what I find is when I talk about a stock name, just people immediately, the natural question which comes is the stock overvalued or undervalued? So it's a contrary approach. I really don't go to the valuation till all the other analysis is over. The reason being, what is the use of valuation or even fundamental analysis if the growth prospect of the company is very poor? And say, assume the management is dubious. Leave even the valuation analysis. The numbers itself cannot be trusted what you see in the annual report. Say if there is more severe competition and it's very clear that its revenue is going to dip in future, profit margins will take a hit. So why even analyze the company further? So the sequence of above steps is more important. Though it's a rigid sequence, sometimes I go up and down, back and forth, when new information, as I analyze, some new information could come, so I go back and forth. And any stage I'm not comfortable with the idea, I discard the idea without any emotions, even if I spent a good amount of time in this analysis. So this third stage, or the rigorous analysis of my framework, sometimes takes 4 to 6 weeks for a single stock I'm talking. Sometimes takes 4 to 6 weeks or even more. The reason being that I'm not full time into it, I have a very limited bandwidth, so it does take time. So all through this analysis, the third stage, what I talked about, I create an investment thesis, which is nothing but a observation from my analysis. It's a running document which I periodically update even after I start investing. So this thesis at the end of analysis will culminate to reasons why I should buy the stock. What are my expectations about the company future and why I am buying the stock? There should be strong five reasons. Reason one, two, three, four, five. This is going to happen because of which the stock price is going to go X times in a certain number of years. Of course, there are a lot of assumptions involved. I don't deny that. But I myself need some strong conviction. Only when this thesis I'm convinced, I go ahead with investing. So when I do all these three stages, when I pass through all the stages, I get very, very few ideas because it takes time as well. There are very few ideas per year which are worth investing. But I need to note here, even if I get one good idea per year, which I'm confident, I'm more than happy. Rest of the year, I invest only in that one company while I repeat this process. So this is a high-level overview of how I do it end to end. I request the viewers, if this framework is interesting to you, please see my 4-hour video in the YouTube channel. That will give you a lot of insights. Over to you, Prince.
That's interesting and exhaustive. Surely, guys can have a look at the YouTube video, and this is in pipeline. So, Venkatesh, like when you are done with the investment, so next question goes for sell. How you go about your sell strategy, basically?
Okay. To be very ideal, this sell strategy should be part of the framework which I discussed just now. But okay, it's better that we have it as a separate question as well as a separate piece of activity. Sell is a bigger and tougher decision than buying, in my personal opinion. So the decision on when to sell or what triggers a sell is taken along with the decision to buy. So this might be a bit confusing. So let me repeat. Even before I decide to buy a stock, I even decide when or on what situation I'm going to sell. As I told you in my previous response, that as part of the investment framework, I create an investment thesis. This thesis helps me with the understanding or reasons why I should buy a stock. Essentially, the contra of the same reasons are the strong reasons why I should sell a stock. That's the reason why this thesis I need to periodically update. So when multiple triggers become a reality, it is time for me to decide whether it is time to sell. Mind you, price level targets are never sell triggers. Like I buy a stock at 200 and once it touches 400, I am going to sell. No, that's not the objective. So to make it slightly more illustrative, say a company I'm expecting is going to grow at 15%, and that was my thesis to invest in that stock. The antithesis or the sell trigger would be if the company fails to grow less than 15%, means not 14%, significantly less than 15%. Say it is struggling even for a growth of 10%. And from the management commentary, it is very clear that they themselves is not confident due to business environment or a regulation or competition. It's very common these days. Lot of new companies, startups come and with PE money and they're just crushing the traditional way of business. So any of these factors make it obvious that it's not going to enjoy the growth which I initially targeted. Then the sell trigger becomes active. So it is now time for me to look into for analysis. It's not a in-depth analysis like this. a certain kind of questions, whether it's a temporary one or is there a possibility of turnaround. So a short analysis before selling. This apart, the other reasons why I have sold in the past was, despite the best analysis, I have gone wrong, or after I invested, the fundamentals completely reversed, or the stock does not fit my framework or expectations. So these are the other three occasions I have sold my stocks. So my suggestion to you all would be that when you buy a stock, you yourself should have a strong reason, a couple of reasons why you want to buy and why you need to sell a stock. So you need to be aware of both even before you buy the stock. So over to you, Prince.
That's interesting and very relevant, I must say. So, Venkatesh, we often see there is so much of noise on macros. So, my next question goes the role of macros in your investing.
Okay. So when you talk about macros, these topics could be around inflation, the interest rates, crude prices, maybe supply and demand, maybe India's GDP, the global political tensions, the like something like Russia-Ukraine war, and maybe even the national and international politics. These could be broadly put in this categories. So for each of these macros, let me phrase this way. For some of these macros, certain inferences are very obvious. So let me take the example of interest rates going up. When interest rate goes up, it is tough for business and naturally it has an impact on the markets. And it impacts the individual stock to a varying degree, not at the same level, but to a varying degree. Say a company which has a very huge debt now needs to pay a higher level of interest, or they are going to find borrowing very difficult. They will have a deeper impact when compared to a debt-free company where there is no borrowing involved. So the impact on both the scenarios is different. And again, there is a customer-facing perspective. Like when cost of debt goes up, then consumption like buying a house also gets impacted, which in turn hits the real estate stocks or maybe even banking, whatever. So likewise, for some macros, it is possible to deduce the outcomes of the outcomes, but it is very difficult to estimate the impact on individual stocks, like to what extent the growth will get affected, which will cause a P re-rating, which in turn will impact a certain percentage of stock price in the long term. I repeat, please mind the sentence. To what extent the growth gets affected, which may lead to a P re-rating, and which in turn creates a stock percentage up or down on the long term, not on an immediate basis, on a long term basis. Usually, you'll find the reaction is instant. The moment the interest rates are declared, you find the market behaves with a negative this thing going down. So it is the reaction is within hours or at the worst on the same date. Another personal observation is many a times the outcomes have turned opposite. I don't know if how many of you can recall the 2016 US elections. So November 8 was a day before the election result, when it was strongly believed that Hillary Clinton is going to win. So I'm reading out the statement from the media. Hillary Clinton has 90% chances of win. Financial markets in general view a Clinton win as a better outcome in today's election, as it presents more stability for markets than a Trump's presidency. So this was on November 8, where they say that Clinton's win is favorable for the stock market than a Trump win. Come November 9th, Donald Trump wins and the stock market closes nearly 2% up. Yes, there was an intraday plunge, but it recovered and closed for 2% up. So just 1 day difference. And the impact predicted was, if Donald Trump wins, here there are two observations. First was, it was strongly believed Clinton is going to win. That didn't happen. And the second thing was, if Donald Trump wins, markets are going to go down. That also failed. So the problem for me when it comes to macros is, There are multiple layers of problems. The first layer is what is the expected outcome of the event? That itself I may not know. Whether Trump will win, if he wins, the market is going to go up or down. The second layer of problem is even if I manage to get it right, say Trump is going to win, if he's going to win, the markets are going to go up. So even if I get this forecast right, how do I estimate the impact on the earnings of my stock? Like say I'm holding a stock XYZ, in what way the stock is going to get impacted in terms of the earnings. So the third layer of difficulty, projecting this impact for a longer holding period. Say if I am planning to hold it for 5 years, I need to know the impact what is going to happen on the 5 years. Means Trump wins in 2016. What would be the impact of Trump's win on the stock price in 2021? That's something is very uh, gray area for me. And the last is there are multiple macros in play. It's not one. There are multiple macros in play in different point of times. Once it would be a war, once it would be a uh, pandemic kind of situation, what we saw 2 to 3 years back. So everything is unpredictable. So since my orientation is long term, I do not factor macros in my investment decision. I have no way to estimate how a particular macro is going to play out and have an impact on my company's earnings, which in turn know what is the impact on the stock price. So I would strongly recommend to read the Howard Buck's memo. In July 21, he has written Thinking About Macros. It's an excellent 1 hour reading on the topic, which you should not miss. He has very clearly outlined why he doesn't prefer macros. The key theme of that reading is the outcome of the macro is not knowable correctly on a consistent basis so that it will help investors to make superior investment decisions. So it is not possible. That is the key theme. So thus, macros don't find a place in my framework. So over to you, Prince.
Yeah, interesting. And I can say plus one on this because I also believe the same. As far as long term is concerned, these small events doesn't matter much, provided you have done your homework on your companies. So next question is which one you prefer, top down or bottoms up?
So just for the benefit of somebody who may not be knowing what is this, I'll just give a very brief background. In a top-down approach, you start with the overall economy, analyze the economic factors or the so-called macros, what I discussed just now, and then drill down to individual stocks. Means you are going to identify which sectors are going to do great in the economy. Say sector 1, sector 2, sector 3. And within each sector, we are going to find out the best companies which are going to profit from this economic growth. So this is the top-down approach. The bottom-down approach is completely the reverse. There, you pick up and analyze individual companies, their strengths, weakness, and your analysis focus only on company fundamentals with very less importance to economic indicators. So this is where these both stack up like. Now coming to what I do, I just had the answer that macros are not part of my philosophy or framework. So a top-down approach will not suit me. So I do the bottom-up approach where I pick individual stocks, analyze and invest in it. So what do you, Prince?
Cool, cool. That perfectly makes sense, Venkatesh. So, Venkatesh, what is your approach to financial statement analysis?
Okay. So by now you must be knowing that I am more of a fundamental camp where I invest on stocks based on the fundamentals of a stock. So if you remember, I talked about a three-stage framework in the beginning, where the third stage, that is the rigorous analysis, one of the steps was financial statement analysis. So the financial statement analysis is the core or the heart of the fundamental analysis in my personal opinion. So even before I would like to what I would like to say is how I use this financial statement analysis in depth to gather insights. So to make that explanation easier, let me introduce a concept. Whenever you are doing the analysis, there are two kind of information. One is hard information, another is soft information. Hard information is something which is available to all the investors, either me or Prince or anybody of you. And this information is not variable, means it does not change between you and me. So all the published financial statements fall in this category. It remains the same and it is available to all. So this is all about hard information. The soft information is the assumptions you make, the expectations, estimations, future projections. Like example, the future growth of the company. That is a soft information. That will vary. One person might tell that IT is completely gone for the next 5 years, whereas the other person say IT is going to have a great future in the next 5 years. So that's where two investors will opinion on the growth will differ, and this is more to do with soft information. So as investors, you need to be mindful of what goes into your analysis and what drives your decision. Mostly we fall for stories on the soft information, believe that as hard information, and we make some certain decisions. This is one reason why I write down investment thesis, where I myself have a clarity what are my assumptions, what am I assuming, what I don't know, what have I picked from the annual reports, what is the expectations which I'm building in. So all this come out very clearly in the investment thesis. So now how I'm going to relate this with the financial statement analysis. So you start with hard information. The hard information is whatever you have the financial statements, and with that move on to add soft information like your judgment, your assumptions and expectations to understand the future performance of the company. So when now coming to the financial statement analysis, there are multiple tools. There are horizontal analysis, vertical analysis, ratio analysis and so on. This financial statement analysis is a very powerful tool which in my opinion is not being used to its fullest potential. This analysis will give you a lot of insights into a management strategy, the outcomes of their past actions, future goals and intentions. It will give you insight of what management is aiming to do in future. Yes, to a great extent it will not be 100% correct, but you will get the overall view. And even the financial statements will give you the financial and operational strength and weakness of the company. So what essentially I'll be doing is the financial statement analysis starts with the hard information. Okay, hard information, what I told you now. And at the end of financial statement analysis, I start adding the soft information like why if this growth was such a such percentage, what can be expected outcome. So this is all soft information because it's all my inferences, my understanding and my assumptions. So this is how I transform the analysis of a financial statement analysis from a hard information and merge it with the soft information. The biggest mistake what I find with many doing when it comes to ratio analysis is they see the number, they see the ratio only as a number. These ratios could be compared with the benchmark. Say benchmark value could be 2. If it is below 2, it is safe. Above 2, it is dangerous. Something like that. So what I would like to say is, whatever you are saying is not a mere number, but the number that you see in your analysis is the outcome of many past management actions and decisions. Thus, this number is capable of giving you inferences of the management's past action and business performance, over which will help you to get pointers for future. So this all could be little confusing what I am talking theoretically. So let me take you a simple example. I'm sure most of you would be knowing about debt equity ratio. So this is one of the ratios, most common ratios used in ratio analysis to see what is the borrowing level of the company. So it is total debt divided by the equity of the company. So there are three broad possibilities. Either the company has a very low debt or no debt. So the value could be somewhere around 0. So such a company is seen as safe. and a value of somewhere 0 to 1.5 or 1 is acceptable limit. This is where majority of companies fall in. And a value of about 2 means it's a huge risk. A company has a large amount of debt and it is risky. So these are the three broad categories or broad possibilities. Now, this we normally people start their analysis or inferences at this level. But I'll just talk how I can gather inferences from these numbers. So in the interest of time, I'll only take the first possibility where the debt is 0 and I'll show you how to gather insights. So the company has 0 debt, but you find the company is having around 10 to 15% growth. How can that growth come without debt? Because for debt, for growth, you need to invest in capex. For capex, you need money, and the company doesn't take debt. So to find out the answer, now I go to the cash flow statement to see what is the cash flow from operations and what is the capex spends. So on seeing the cash flow statement, it will be obvious that the cash flow from operations shows a large amount of cash that is directed to capex, and you can validate this on year. Just don't look for 1 year statement. Pick up some 4 or 5 year statement and try to see whether they are doing this on a every year basis. So by now you get a clarity that the growth is funded by internal cash profits. So they are not going for debt because they are getting it funded through their own profit. So now your next question should come: how the company manages to generate so much cash? That answer you get only by seeing the profitability ratios, particularly the return on equity and so on, which will be very attractive. Only then you will be able to generate so much cash. So the analysis now will shift from cash flow statement to profitability ratios. You will see that I started with a simple D ratio in the balance sheet. After a few questions, I reached the cash flow statement, and from the cash flow statement, I moved to the profitability ratios. All the way, I am gathering inferences of management strategy. So, what are the inferences? First thing is, management is funding their growth based on internal cash with minimal or no external borrowing. So, they are following a more conservative approach. And their borrowing capacity is intact, which can be leveraged for future growth opportunities. So, what do I mean by that? So, let me say the company is having an equity of 100 crore. With no debt, the safe limit is the company can go up to a debt equity level of 1:1, which means the company can still borrow another 50 to 100 crore comfortably from the borrowers. So the borrowing capacity of the company is intact to the extent that future, if it needs cash, it is able to generate 50 to 100 crores comfortably. So this is the way you need to draw inferences. So I request the audience to read my 10-minute blog on did you see the debt equity ratio this way, where I have covered all the three possibilities. I only discussed at a very high level on one of the possibilities. In the blog, I have covered all the three possibilities on how you can gather inferences even through trend analysis. Now you will see that a single ratio can give you so much inference. Imagine how much you can gain by doing such an in-depth analysis of all available ratios. Again, don't stop this analysis with only one year statement. Do it at least for 2 to 3 years, and then you will get a neat story about the business management, which will be a good guide for future. The other thing is, whenever there are outliers, excuse me, you need to figure out why or how. You need to figure out why or how. Say example, there are 5 companies or 5 competitors to your company. All of the companies, other companies have a ROE less than 10, but your company alone has a ROE greater than 15. So now you have got more work to do. You need to find out what is special in your company that they are able to generate such a different ROE. What is special in the business model or strategy that keeps the company apart? So this is the kind of depth one needs to get into financial statement analysis that will cover a lot of insights about management strategy, and even give you pointers for the future. So before I conclude this, Prince, I just want to respond to one question by Mr. Sandeep Mandal. It's on the same topic. Please cover how free cash flow alone or combined with other parameters can be used for investing in stocks for the long term. Do they help in guiding when to exit as well? This was the question by Mr. Sandeep Mandal. So my answer would be like the free cash flow is undoubtedly a very very interesting metric when it comes to financial statement analysis. Just for a background of who may not know what is a free cash flow, it is the difference between cash flow from operations and the capex spends. So what are the insights that it gives? The company has some cash left after its growth plans. In general, a positive free cash flow is seen as a very strong and a favorable indicator in the stock market. To quote Mr. Saurabh Mukherjee in one of his videos, he says nearly 70% of the Nifty companies have not generated even 1 rupee of free cash flow in the last 10 years. So it means that there are very less companies which generate free cash flow. So I can see companies generating a good free cash flow as a special breed. So one thing to keep in mind is companies do not generate free cash flow right from year one because they need to spend a lot on branding, marketing networks, research, product launch, and so on. So you will not get a positive free cash flow at least for a few initial years. And once they stabilize, they spend more money on capex. So again, even after a few years also, you don't get a free cash flow. Only after a long period of legacy and past successful execution, a company can consistently start generating positive free cash flows. Now, these are all the goodies what I spoke. Now, coming to a different or contra view, from my own analysis, I have seen there are not many companies which generate free cash flow year on year. So, if that is your thesis for buying, then your universe of investable stock is very, very less. And the second point is, let us assume for namesake, I get a company which generates a good free cash flow. There are two things to catch here. First is what the company is going to do with their free cash flow. Are they going to retain, keep it with themselves, or pay back shareholders through dividends, or go for some lousy buyback at very expensive prices? We don't know. Anything can happen. Similarly, a company with such a free cash flow will definitely have a very, very high valuation. So, are you going to buy at any price for such a good free cash flow? My answer would be no. I'm not comfortable to do it. But if you are comfortable and confident that even if you buy at a high valuation, you could make profit, then you could buy. So the last trailing point was, should free cash flow be used for exit decisions? Say, suppose we have brought it for a healthy positive cash flow and which suddenly becomes negative now. So you want to use it as a trigger to exit the stock. But the negative free cash flow could be more due to capex. So do you want to exit just because of negative free cash flow resulting from more capex, which is going to give you a higher free cash flow in future? Definitely no. So in my case, I definitely use free cash flow to gather inferences. Like a continuous negative free cash flow means it constantly needs funding and they don't have sufficient cash to support capex. Those kind of inferences I do make, but definitely not a buy or exit decision either with free cash flow, either on a standalone basis or in combination with other ratios. To get a meaningful insight into free cash flow on related with the company's growth cycle, I would strongly recommend you all to watch a video by Mr. Saurabh Mukherjee titled "How Rising Giants Drive Acceleration in Compounding." This was released in January 2022, and somewhere is one of his fund managers, Mr. Ashwin Shetty, very beautifully explains about this concept of free cash flow and how it is related to the growth cycle. So, ignoring his fund performance or views on a particular stock, I would request you all to take a neutral stand, see this video to get a good insight on this free cash flow. So that was a rather a long response. So thanks for your patience and over to Prince.
That's quite impressive and seriously, I mean, very, very well explained, Venkatesh. So let me digress a little and take a deviation from the question. So let me ask you about the new journey you have just embarked. So, how had been your experience with your first book? Tell us more what all you have covered in that book and what readers can expect from that book.
Okay, thanks, friends, for this question because this was something of my recent project. So I would really love to talk about it. So writing a book was my multi-year desire. So it was for many years I have been desiring. But somewhere during the COVID lockdown, I thought I should make it. And the end of 2020, I decided I should write a book. However, this also was a do-it-yourself project. I did not know anything about it. There was only questions but no answers. So I took a help of few fellow investors who have already written and published a book. So all of them were kind enough to spare the time to put their best effort to guide me. The topic is saying no is a much researched subject after my academic years. So I do know a lot about the subject over this last 20 years or so. But I was not clear whether it is good enough to fit into a book. So having some ideas in mind is one thing, whereas putting that idea as a structured book is altogether a different thing, which I was not knowing how to do it. As a person, I hate myself being pivoted to a comfort zone. The moment I realize I'm into a comfort zone, I deliberately do something to push myself out of the comfort zone. In this particular project, writing the book, every step was new to me, like learning, searching, discussing, figuring out, and make some decisions. Everything was new to me. Thus, this project was continuously moving me out of my comfort zone, which exactly is what I also wanted. So, in short, I enjoyed the journey of writing the book, and now I have made the journey once. I know where the entry, how to navigate, and how to exit. So, I'm confident that I can write my next book with the minimal effort and the best possible manner. So, to specifically talk about the book, it's a very important topic that each one of us needs in our professional work or social life, personal life. So, if communication is a skill, assertive communication is a small subset where you boldly express your views. Within that assertive communication, saying no is a smaller subset that you're going to boldly say no. But it's not easy to say no to somebody because even if you manage, so this book is all about that, like how to say no without fear, without guilt, without regret, and at the same time not disappointing your requester. So there are around 12 chapters in this book covering why we hesitate, the reasons why we hesitate to say no, the myths we carry, the rules to say the proper no, four-step framework to say this no, along with a few practical cases. To say no, there is an inner transformation which is more important. This book will help you to bring that inner transformation in yourself to say your rightful no in the right manner, in the right situation.
Venkatesh, I cannot hear you. Let me add you as a speaker again. I think you got dropped. I sent you the request again, Venkatesh. And guys, like the interesting discussion which is going on, and I would request you to listen it from the starting till the end because it is structured. And if you miss down on one part, then definitely it will be difficult to understand the ensuing part. So Venkatesh, if you could hear me, I have sent you the request again. And in case you are facing any issue, kindly drop once and join again, and then maybe will be able to add you. Venkatesh, don't know why you got dropped, but in case you are able to send speaker request from your end, please try. I have sent you twice. Let me try once again. And in the meanwhile, guys, if you're liking our spaces, do connect with us. If you haven't connected already, and do give us a follow. That gives us the motivation to bring more learned people. And trust me, this session is one of a session which we can call and very structured and very meticulously uh, the data has been shared with you, and many people who just start their journey are clueless how they should go about it. I would say if you listen to the this video, sorry, audio from the starting to the end, and try to implement that thing on your own, surely down the line you will be doing great. So I see Venkatesh again. So let me check. Venkatesh, I have sent you request again. Are you able to
Yeah, I can
join
I
now?
can hear you. Can you hear me?
Yeah. Okay, thanks. Sorry, that was some glitch on the Twitter's part.
Yeah, Twitter
So yeah,
Twitter hanged, so I had to restart actually.
okay, no issues. So go ahead, Venkatesh. You were talking about the book.
Yeah, I have done with. So I hope you were able to hear my response, right? So
Yeah. Before you got dropped, everything was audible to every one of
okay,
us.
so I have done with that response, Prince.
Great. So Venkatesh, what is your approach to risk management as far as investments are concerned?
Okay, so the very definition of risk is very subjective. Few common ones will be English dictionary will say it is a danger. In personal finance or stock, finance planners, they will say that it's a difference between the expected and actual returns from an investment. And many of the gurus whom I follow say that permanent loss of capital is the main risk. For a short-term investor, the volatility in stock price is the risk. And an interesting definition which I came from Mr. Asad Damodaran was risk provides a danger plus opportunity. So it's quite possible that when you talk about risk, what I have in mind and what you are having in mind is completely different. So we need to have a common understanding. So let me clarify what I see as risk. The English dictionary meaning will be of little or no use to the investing world. So I'm ignoring the English meaning, and I'm not a trader nor a short-term investor. Hence, volatility is not my concern. So that perspective also I'm ignoring. So my biggest concern is the permanent loss of capital is the risk what I foresee. So that is the only risk which I need to worry. And one level below, I am more focused on the impact of the risk rather than the risk itself. So what I mean by the impact of risk. So let me put it this way. Just for argument's sake, let me take myself or my good friend Prince. So we both have the same stocks, invested in the same stock for 10 lakhs. So what is the big risk? Permanent loss of capital is what I told you. So all the 10 lakhs is washed off from our portfolio. It is completely zero. So now what is the impact on me and Prince if this risk happens? So here is where it becomes a subjective idea. For Prince, the stock could be a 5% of his portfolio with no immediate purpose of this fund need. Whereas for me, it is 50% of the portfolio and the money is meant for my retirement purpose. So now how the impact goes is, no doubt for Prince, it will be a hard burn to see 5% of his portfolio gone, but the impact is nothing because there is no immediate need for the fund. Whereas my case, it is 50% of my portfolio, which is meant for retirement savings. I need to make up this loss in my retirement kitty as soon as possible. So for me, the impact is big. So what you saw in this example is it's the same stock, same amount invested, and the risk is also same. Both of us lost money, but the impact on both of us is different, completely different. Hypothetically, to analyze risk, each one of you should put yourself in the real risk situation and see how you will be at that time. So this is a quite different approach when we what we see from academic works. Usually, there are beautiful formulas which talk about a risk of a company or a risk of a sector or a country specific risk and so on. So, first thing is I don't understand that. Second, I'm not comfortable with such approach. So, I see risk this way. So, what is the risk? And if it materializes, what is the impact on me? So, that's how I handle risk. So how do I handle this risk of permanent loss of capital? One thing obvious is diversification, because with a even with a concentrated set of stocks, say you have only 5 to 6 stocks, it is highly impossible that all the 5 or 6 stocks will have a permanent loss of capital. You will have maximum one stock. So all these 5 or 6 stocks going to a permanent loss of capital is a near impossibility. And at the second level, I would try to invest in companies which would not suffer permanent loss of capital. So that's where the filters, what I talked, would come in, which what I've already discussed would come in. So like I would definitely avoid debt heavy companies, highly competitive industries, loss making companies, dubious management, and so on. And invest in companies what I understand well, where I'm confident about, sectors where there are very few companies, where there is less competition, and the companies have a proven past record of sales, profit, growth, and operational metrics. So this kind of approach will help me to ensure that I do not suffer this permanent loss of capital, the biggest risk which I fear. So that's all from me, Prince.
Great, Venkatesh. So, Venkatesh, like Nareen had one question, like how do you assess the management, and apart from reading annual reports, what all you see while analyzing in a company?
Okay. So thanks, Nareen, for raising this question. Because incidentally, when that tweet came up, I was just putting the notes for that same question actually. So management quality. If you remember the first question where I answered about my framework, rigorous framework, management quality was at the second step. First was business, then comes the management. So one wrong notion about management quality is it is not possible to evaluate. It is far from truth. So we need to keep a few basic things in mind. It is possible to evaluate management integrity, but you cannot evaluate 100% depth, and you cannot be 100% right all the time. That is one big caveat you need to have in mind. See, we all as individual investors have some limitations, a lot of limitations, not some. We have a lot of limitations when it comes to stock investing. Like I can analyze or form an opinion about my friend or a workplace peer because you're spending quite a long time with them, you talk with them, you see what they are doing and so on. But when it comes to company management, you really cannot do that. You hardly have their media appearances or interviews and connection through con calls. And this is the only option for you to make the perfect or the right judgment. So it's no doubt it's difficult, but it's not impossible. And the management quality has only one answer. It's either good or bad. There is nothing like in between, either good or bad. Nothing like that. It's either good or bad. This management quality has both qualitative and quantitative pointers, and qualitative is where the subjectivity creeps in. Like what is perfectly fine for one investor is completely suspicious point for another investor. So let me take a hypothetical example. A company decides to buy out a company held by the promoter family. So one investor might oversimplify the strategy saying that it's a perfect strategy for growth. Whereas a Sherlock Holmes style of investor will have a lot of questions whether the valuation is justified. Is the acquisition the best interest of shareholders or the related party? Is the acquisition itself is justified? And so on. So it's a very subjective idea. So it's very difficult to have a perfect answer. And many of us are looking for a kind of metrics or a very structured way to analyze management integrity, which doesn't happen that way. Excuse me. It has got more to do with the art part of investing. Most of us are very comfortable with the science part of investing, dealing with numbers, ratios, etc. But when it comes to art part of investing, where you need to bring in your own inferences, we really don't want to make our hands dirty. So we just want to stay away. So that's why we find analyzing the management quality is a bit difficult. And the other thing is, when analyzing management quality, please have a open or a neutral mind. Normally, we are already biased based on the inputs from social media or media. We definitely carry either a positive or a negative bias. The best example is there is a big industrial conglomerate in news for the last 1 month. You pick up that name, people will either strongly object or abuse, saying that there are corporate governance issues, or the other camp will strongly say that it's a hit against nationalism. Everything is right at its end. So that way, we already have some bias. So when you do this analysis, you need to be neutral as much as possible. So yes, it's difficult to gauge management integrity, but not completely impossible. We as retail investors have very limited access, but nothing stops you from gathering information from whatever is available. A few pointers are very obvious. So let me discuss three such pointers. But remember that management analysis is a place for a good amount of deductive work. You need to raise a lot of questions. You need to see things with suspicion. And this management quality has a very, very important place in long-term investing. So let me quickly go through those 3 pointers what I told you. The first one is the auditor's report. So it's a gold mine, I should say. And this is usually the first place where I start when reading the annual report, because I don't know anything about the company. I would like to understand what the auditor says about the company. So the auditor writes this report after auditing financial statements, and this report has their audit observations. One specialty about these auditors is these are the guys who work very closely with the company more than any other stakeholders. Like retail investors, you and me can never imagine sitting inside and analyzing the account books, but they can do it. Here comes a counter argument saying that auditors are in doubts with the management. Such things can happen despite auditors. And even many companies where corporate governance issues surfaced, auditors had been there, but it didn't come out. Yes, it is true, but over the years, many things have changed. Now, auditors are resigning if managements are not cooperating actually. They do highlight in the report saying that they were not given the document they requested for, or there was lack of cooperation. Even in hindsight, you say that there was a corporate governance issue in recent any 5 companies you take, read through the annual report. I'm sure you'll find the auditors have raised the flag in the report saying that we could not audit these areas. We just went by what our management said. So those kind of lines will be very clearly there. So even if you don't want to believe an auditor's opinion, don't believe there is a clean opinion. But if the auditor himself has given a suspicious opinion, what more do you want? You can trust that, right? So before investing, before you pick up any company, do read the annual report and pick up this auditor's report, where you'll find a lot of insights about the quality of accounting and about management. So my fifth blog on stock investing completely deals about drawing inferences on auditor's report. Please do have a look at it. Then comes the second pointer, that is the salary or the remuneration. Analyzing the salary the promoter takes has a lot of insights about management insights, intentions. Here there is no right or wrong answer that 10 crores should be the right salary or 20 crores should be right salary. No, there is no right answer. But you can compare this with peer companies to get an idea whether it is high or low. Does the salary they take compensate the performance they bring in for the company? Say, the performance should not be in terms of stock price. I'm talking about the business performance like profit growth, revenue growth, debt reduction, so on. There is no further thought required that when there is a meaningful rise in salary without a meaningful rise in performance, why should they take such a salary without giving a performance? So these are very obvious things. There are some cases where salary is very less, but they take even 7 to 8 times the salary amount as a commission. So what more insights do you want? So these are all reflections like of management intentions. So like if there's a CEO who accepts only 1 rupee as a token compensation, It speaks a lot about their intentions and how they treat shareholders. One case a couple of months where I saw was there was a directory for corporate social responsibility, and the salary for the director was much higher than the actual spend on the corporate social responsibility. And the director happens to be spouse or son, daughter, I don't know. It's a direct blood relationship. So, what more pointer do you want? The family member is the director of corporate social responsibility, and the salary is more than the actual spend on CSR. These are all very obvious things, but we don't bother to check it. Then the third pointer is the related party transactions. Does the company have a lot of transactions with the promoter held subsidiaries? There are companies which buy even raw materials from subsidiaries which are held by the promoters. They buy even fixed assets from the entity held by the promoters. They give fatty loans to the promoters. So does it not indicate something to you? So what is the overall size of such transactions? Say they are buying raw materials, etc., etc. Is just 5% of the total expense. You need not give weightage. But if it is something around 40%, then definitely you need to deep dive more. Try to probe more. What is special in the raw material that they don't get it from the open market or any other supplier, but only buy from the promoter held subsidiary? Some things are obvious. In fact, one company which I was analyzing some 3 years back, it was showing multiple pointers, like their compensation was very high when compared to the peers. Beyond salary, huge amount of commissions were paid. Why commission? No idea. Huge amount of commissions were paid. And multiple transactions with the entities owned by the promoters. Raw material, fixed assets, everything was from the promoter group subsidiaries. So this is well captured in my with screen grabs in my 3-part video on analyzing management quality. I would request to have a look at it. And just before I close, I would strongly suggest to read Dr. Vijay Malik's blog, where he has put his observation, many such observations on management quality on different companies as analyzed. These blogs are a good starting point for you to understand about management quality. So over to you, Prince.
Yeah, Venkatesh, like many of the points you already covered, but there is one question, like annual reports are becoming bigger and bigger. So, what is the best way or maybe the effective way to read an annual report?
Okay. Yeah, I too saw this question. It was from Mr. Shakti Ganesh, who had expressed this interest of this question. I too had a similar observation or thought, like the annual report of the number of pages in the annual report in the recent years has been increasing. It has become very colorful. And this is particularly true after the years when companies stopped printing and distributing hard copies. When they were printing and distributing hard copies, I think it was much slimmer, thinner, black and white. But once they stopped that and only digital mode of annual reports have come, now it has become a little bulky, no doubt. But we as investors must still review the section which will help us to make investment decisions. The first and foremost is the sections where they talk about money. That is the 3 financial statements: balance sheet, profit and loss, cash flow statements. There are many stock services who have this information, but still I always have preferred to pick it from the financial statements. I always prefer to pick it that way. And just now I talked about the auditor's report. Yes, auditor reports precedes 1 or 2 pages before the financial statements. They give a flag about their observation from the audit, and it will help you to form a view whether the numbers can be trusted or if any adjustments are needed. Sometimes it's not a trust issue, but there is a difference of opinion issue. What a management sees money will be recovered, the auditor feels it may not be recovered. Some slight adjustment is required, that's all. Say a few crores, management feels very confident that they can recover it from the suppliers or whoever. But auditors of the opinion, it cannot be recovered. So that small amount, if you adjust, then it's good to use. So then Immediately after financial statement, you have the notes section. That is the supporting section to the financial statements. Though what I say will be a bit of exaggeration, this notes section is much more important than the financial statement themselves because it carries the breakdown and the explanation behind the numbers what you see in those three statements. In case the company has subsidiaries, then it will publish even consolidated statements, which are also important. So now, all whatever I said now was all around the money or the finance numbers. What are the other sections to look for? So in the beginning, I told about 10-year financial summary. So this financial summary gives a 10 years performance. You get a lot of inferences. I refer to my blog. Please read it, and you will get a lot of insights how to do this analysis. Then there is one section called management discussion analysis. It's a good repository of sector knowledge. It talks about the economy, how the sector was that previous year, and how the company performed, and what are their future opportunities and threats. So when you talk about opportunities, when you read about opportunities, please be very cautious. They are a kind of expectations. They are hoping that they will grow by 15%. It may or may not happen. So have that in mind. Then comes the management compensation. Just now I told you, you need to review the management compensation. There are separate sections where the salaries of different directors, promoters, etc. is well tabulated. Then comes the views from the management. So that is typically the beginning titled as letter to shareholders, where they talk about their year's performance, that year's performance, and what could be their future plans and ambitions. Then comes the related party transactions. This related party transaction also we discussed just now. It gives a lot of insights to management integrity because it's a transaction which happens between the listed entity, the company, and between the promoter or an entity held by the promoter. Lastly comes a company biodata page where, not a biodata page, a few initial pages where they talk about their history, their product, the nature of business, etc. This will help you to understand what is the business the company is into. So these are the major sections which you need to go through. This is not an exhaustive one, but a sufficient one. I'll definitely put a future blog to cover all pointers with more examples. So over to you, Prince.
Great, great. So let me give some time to the attendees to absorb the great knowledge which you just shared. So let me again take a deviation as ask about your website. So what led you to your journey with success projects, and like how our attendees can benefit from the website, the content which you shared over it?
Okay. So my stock investment journey I spoke, but I didn't talk about my personal finance journey. Maybe if there is interest, we can do something in future. Maybe after a couple of months. So when I started earning, um, there was complete ignorance of ignorance on personal finance actually. Though I got guidance from my father, I didn't what to say take it so seriously. So, but once somewhere I was on my own managing my earning and expenses, then all the trouble started, and then there was a hunt for framework there also. So that led me to a lot of learning on personal finance. So that is the short of my journey there. Back in my workplace, I used to find that people used to spend a lot, and in fact, it was bad to the extent that people used to spend money and they don't have money for the last 5 days of the month till they get salary, even for eating actually. So I used to give a couple of my junior employees money to for their lunch, dinner, and so on. So that is when I started discussing and guiding these people on personal finance topics. So where I used to say send their daily mailers to a couple of my colleagues with one lesson per day. So that mail used to be titled as Empowering with Financial Awareness. So who are following me for quite a few years will be knowing that that was my initial handle name. So only in the last 2 years I have been able to express myself in social media or my website when I have started my topics on stock investing, productivity, and time management. So with this topic, this title, this handle name empowering financial awareness was falling short to cover these topics also. So I and my friends were brainstorming what will be the right term, and somewhere the main thought process behind was we all want success in life. On the main perimeter where we are looking at success in profession, finances, or relationship, maybe few other things, but these are the main. And each of us has our own definitions of success. So that's how determination came that the success should be in the domain name. And I strongly believe that my journey in personal finance, stock investing, and this productivity or a career related topic will help others in their journey to success. So that's how came this term success project, which aligned with my objective and intentions. So far, as you rightly told, I have put around 60 blocks on these three topics. These blocks are not just random thoughts or views with a few lines, but they are a deep dive analysis with topics covering practical examples so that readers can benefit from these topics. So I'll be writing more, but of course, yeah, we all have a constraint of time. Within that constraint of time, whatever I can write, I will still write. Please do share with your friends if you find it useful. Over to you, Prince.
Great. Many thanks for your value addition to the community. And there is one comments like where people can find in sorry, the the blogs and all. So if you look at the handle of Venkatesh, and if you visit the main page, surely you will get a link to it, and there you can check for it, right? So Venkatesh, like we let's move on to investing questions again. So what do you prefer, averaging up or averaging down, and what is the rationale behind your choosing either of the two?
Okay, so averaging up and down. So in both the scenarios, if you see, there is a couple of mental accounting or behaviors that is coming into play very unconsciously actually. So understanding this is more important to help you decide what you should do as an investor. You need to bring a change in your thought process to handle both the scenarios. Well, let me consider the first scenario, average down scenario. The stock goes below your average holding price. So this kind of situation happens when you are in an extended bear market, like how I faced one in 2008, where prices fall continuously and stay depressed for long period of time. So such times are wonderful opportunities for you to average down. But here is where the thought process or your mental accounting starts to play. Let us say the stock you bought has gone down by 50%. Now, will you be happy that the stock that you already own has gone down 50% low, giving you an opportunity to buy at throwaway valuations? Or will you be sad that your already invested amount is suffering this 50% loss? You sometimes you will feel like I should have rather waited rather for the making the initial purchase. If I have waited, I will not have suffered the 50% loss. So now instead of buying and averaging down, you would think, oh, let me wait for some more time to see if it still goes down so that I can get a better average. Maybe at the next level of thought, you may even want to liquidate your current holding even for a loss and buy them back at a still lower price. So this all typically happens in an average down scenario. So now let us see what happens in an average up scenario. The stock you brought goes up considerably above your average holding price. This happens in a bull market and the stock keeps increasing and stays at the elevated levels. Typically the kind of time what we are seeing now for last 3 years. Sensex crashed up to 25,000 or 27,000 in COVID, and now we are in 60,000. And I think last 1 year we are in the same range of 54 to 60,000, whatever. These are typical times. You will not get much opportunities to average down. You may have to do only average up. Because if you wait to do average down, you will end up not investing huge amounts of money in a good stock idea. Now here also there is a different kind of thought process what comes into play. So let us assume that your stock prices have doubled. Now, will you be happy that your current investment is sitting at 100% gain, or is it going to pinch you that I have to pay double the money to buy the same stock than my initial purchase? This is how mental blocks come in. You may feel like sell the current holding, make that 100% gain, wait for some more days for a slight dip, and buy back again. So, in either scenarios, either average down or up, you see that there are different thought process that will actually hold you. Excuse me. I have passed through all those dilemmas. I have made mistakes also. By missing attractive prices, thinking it will go down further. Like the recent one was the March 2020 crash. I was hoping the prices will still further go down, but within few days, markets as well as the stocks what I own zoomed up to a level even to above the pre-COVID levels. So, how can an investor handle this? More than the average up or down, there are two other things which matter more actually. First thing, be either average up or down, you must be on the right stock first. That is a more important thing. You need to have a lot of conviction on your stock idea and thesis. You should not get a doubt. The moment your stock goes 50%, is my investment is right or wrong? Should I sell it? That doubt should not come. So that conviction comes only through a strong analysis. Yes, if you are lucky, you will get opportunities to average down. But if you are not, be willing to average up also. Excuse me. Remember that you cannot buy at an exact low point. You have to buy at multiple price points. The second thing is you might be mentally ready to average up or down, whatever. But for that, you need to have cash. That is more important. So, integrating all the above, what I do is I periodically buy. I am deliberately not using the word SIP, but stick to the word periodic purchase. I periodically buy at different price points, whether it is average up or average down. My framework helps to pick the right stock. This gives me the conviction and confidence whether I'm going to do average up or down. So, to put the numbers in place for better understanding, because when numbers are there, it is more exciting. So, let me put some numbers. I'm taking a hypothetical example of a stock which is trading around 200 rupees. Based on your analysis, estimation, future growth, everything, your thesis is the stock will go to 2000 rupees in 5 to 7 years. So, in all this journey, the stock will travel from 200 to 300, 300 to 400, then maybe sometimes it may come back to 350, then again 500, 600, ups and downs, finally it reaches 2000. So, it is no doubt enticing that you buy at 200 and earn a 10x returns. Yes, everybody wants it. But should this mental block stop you from buying at 400 rupees, which is a 5x return, buying at 500 rupees, which is a 4x return, or even 1000 rupees, which is a 2x return? If I am there, I will not hesitate even to buy at 1800 rupees, though my initial purchase was 200. If the original thesis is intact, I am comfortable to buy at much higher prices. If I get a chance to average down due to some reason, like there is a war breakout, there is an impact on market, volatility is there, those are your lucky times where you can buy more and average down. Otherwise, most likely we will face only the average up scenarios. So let me close this with a clarification of what I would do if the stock touches 2000. See, after 5 years, if the stock touches 2000, would I be selling it? No, I would relook the company with a fresh eye. From there on, what the stock can do from another few years down the line. So based on that outcome only, I used to make a buy or a sell decision. Just to add, I was talking about a periodic purchase in this question. So I'll just add a response about my approach to portfolio construction, diversification, and position sizing, which one of my friend wanted to answer. So I'll just club my response along with this here. So as I told in all my previous responses, I get only very few stock ideas per year, and once I decided all the possible money for the next 12 months, I'll put in that stock. At the end of every month, I invest in the stocks. But again, I'm flexible. Should there be some bad news or some beaten up stock and where I get an average down opportunity, I deviate from the rules. Instead of the new stock, I try to average down on the other stocks which I already hold. When it comes to diversification, I manage diversification without any strategy. It is just a natural process. Every year, I study one sector in depth along with all the companies in it. It's usually a 4 to 6 months exercise. So those who are following me for quite some time would have seen my earlier post with notes on my sector studies. In the last 2 years, I have covered rating industry, tobacco industry, and very recently I have shared around a 20-part blog on the diagnostic industry in my website. And currently, I'm studying the power industry, which I hope to share by mid of this year. So thus, I would invest on stock ideas which are from different sectors, which take care of diversification. So if you are going to ask me how you choose a particular sector, for sure I'm not behind any hot stuff. It's just a random selection. Like how diagnostics came to my focus was there was a talk by one Mr. Vivek Mashrani about one of the companies in the sector in investor meet at Bangalore. I found that business model was very unique. So I thought I must study all the other companies in that industry, and that's how I landed in diagnostics industry. Similarly, power sector came to my radar for two reasons. One was Sri Rakesh Jhunjhunwala somewhere in September 2021 was talking about that there is a very big reform that is coming up in the sector and the sector is poised for a complete change. And the second trigger was when I ran the screens, I told you, right, I'll be running some screens occasionally when there is something in mind. I'll run some screens and see what are the companies that come up. When I ran up some screens based on high dividend yield, curiously, many companies from the power sector came up. So I just wanted to understand whether it was a case of a complete sector neglect that is leading to undervaluation for all the companies. So that's how I pick up the sector study, and this sector study takes care of diversification. So this is my approach towards portfolio construction, diversification, and portion sizing. So over to you, Prince.
That's great, great, and so well explained, Venkatesh. So, Venkatesh, like behavior in the market is a very important aspect. So, I would love to know what is your view on behaviors in investing, like how to deal with that, and what could be a possible best way to condition that.
Very true, Prince. We try to understand everything else. We try to understand the economy, politics, international politics, sector, and very rarely we try to understand about the company what we in the invest. And within that, very rarely, very few people try to understand about themselves, their expectation, and such kind of things. So our behaviors have a very major role, not necessarily in investment success, but in the journey altogether. So I have just picked a few behaviors based on my journey. First is mistakes. I need to acknowledge my mistake to myself. This will help me to see with an open mind what I did or where I went wrong. Also, when you acknowledge a mistake, a trigger comes to you next time when you are about to repeat that mistake. So that is one thing. And one thing usually I found interaction with some investors. One common question which comes up is, so what is your top five what to say mistakes or learnings? So it is good that we try to see others' mistake, but much more important and much more valuable lies in your own mistake, what you have done in the past. Because when you talk about other mistakes, their thought process is different, their investing framework is different, their situation is different, and above all, the emotions involved are very much different, which you will not be able to see through when they talk about their mistakes. So more than others' mistake, your more mistake is very much valuable. So work on those mistakes, acknowledge and work on it. Then comes patience. A lot has been said about patience. So people say about patiently holding a stock. In my opinion, patience is needed even when you're buying and selling a stock. So my framework very much aligns. So even before I buy a stock, it's almost 6 to 8 weeks I spend to make a buy decision, and sell a stock. I take a long time before I decide, yes, I have been wrong. I need to sell the stock. So there also one needs to have patience. And a very important behavior or characteristics is being decisive. You need to own your decision for buy and sell and not based on others' input. Muthu Krishna sir often says, if you are asking stock idea to others, you are not ready for self-investing. Yes, it's right. You need to be in a position to decide. I have come across many people who are just not willing to take decisions, or they are just indecisive. A simple example is, I present all the facts about a company, but still people are not in a position to decide with a yes or no. They just lean back saying that you yourself say that. Not even stock, even leave it in personal finance. It's something about a term insurance. I take them through a process. So this is exactly what you need to do to arrive at what amount you need a term insurance. Purely mathematical, nothing subjective or objective. Purely mathematical, where you need to put in a few formulas and say, yes, I need a term cover of 1.25 crore or 2 crore or whatever. That people don't want to take that decision. I don't know what is the reason, but being decisive is a very important behavior and characteristics. Next comes is taking ownership and responsibility. You take ownership of your decisions, either good or bad. In case of bad decision, introspect what went wrong. This relates to what I talked the first behavior, that is a mistake that I just discussed. So introspect what went wrong, and that will be a lesson for you in future. What normally happens is when a stock pick goes well, even by luck, we tend to see it as our success. But if the stock doesn't go well, we try to blame every and any factor, be it COVID or economy or government or rate hikes, anything for that matter. So you take complete responsibility of your good or bad outcomes. Normally people are picking stock based on somebody's advice, and if it's a loss, people blame the recommender. I would rather say you need to blame yourself for believing that person and committing your hard-earned money based on the other person's advice. So you need to take complete ownership and responsibility. Last one, not last one, I'm sorry. The next one is a clear thought process. This is also in a way related to decisiveness. Unless your clarity is there on a subject, you will not be able to be decisive. When you're making a decision to buy a stock or sell a stock, you need to have clarity of why I need to do that. That's where I told you about that initial thesis, investment thesis, what I talked about, where you have clear reasons. I'm going to buy the stock for these top 5 reasons, or I'm going to sell the stock because of this 7 reasons. Such a clarity will come only if you have an adequate understanding of the stock. The next behavior will be humility. This is an idea which I came across a Google talk by William Green, where he says that be humble for the possibility that you could be wrong, and be open to the idea the other person is correct. So I fully agree with that, because remember, in investing, we do not have most of the information. We just go by certain assumptions, expectations, and so on. So be humble. Do not compare yourself with others, particularly when it comes to returns. See, example, let us take 2 students, both have the same teacher, and the teacher teaches the same content to both the people and give the same question paper, but still the 2 people will get different scores. What reason? Multiple reasons, but they are not comparable. You cannot compare why this guy is scoring more or less. It's the same with investing. Do not compare your returns with others. Instead, rather compare yourself to your last year version. What am I doing better in this year when compared to last year? So do such a comparison. And the last behavior, I don't have a proper term, so I'm using the term comfortable. Be comfortable for living with uncertainty. So the stock market collectively, or your broker, or the company you invest, none of them have any obligation to give you a positive return. Once you invest in stock markets, you are embracing uncertainty. It could be any random event. It could be a COVID pandemic, a war, or corporate governance by a big conglomerate that could shake up the entire market, or there is some regulation by the government, or there's a price cap that impacts the sector. Anything could happen. None of this can be foreseen. In fact, the impact could be such that your complete thesis would have gone wrong. It could be like that. So, as a long-term investor, you must accept that uncertainty is part of your journey. There are two best examples what I can talk about. So, somewhere in 2018, I was studying the rating sector. I told just now, right? I studied the different sectors. So, I was studying the rating sector, and the main trigger why I picked those two companies was there were only three companies in the sector. Rating sector was having three companies only. So that was one main trigger, which I like with lesser companies. And my friend, who is a overseas fund manager, who is a fund manager overseas, also expressed interest in the sector. So I deep dive, made a report, and it was like rating industry was almost like a gold standard. Nothing to point at it. Hardly 2 weeks passed. I had shared the report with my friend. Then the ILFS issue surfaced. The ratings of the ILFS was degraded. The corporate governance issue on one of the rating companies surfaced. The director resigned or was asked to go on leave. And the rating company stock itself started hitting lower circuit every alternate day. This is a perfect example for a power of uncertainty. Perfect example. Where I thought was a perfectly a gold standard sector, but completely it became like a having a lot of governance issues, corporate governance issues. The second one was there was a company which I analyzed completely in depth. Everything, almost everything I know about the company. Then, when I investing, the promoter had sold their stake to another promoter. Now, structurally, everything is intact. Whatever analysis I think, everything stays. Only thing is now, the management is different. So, this is uncertainty. Yes, I have done everything. There is nothing wrong in me. But it is just a corporate action where a promoter sells a stake to another person. It's just a corporate action actually. So these are all, but okay, to tell what I know, I am just waiting for the new management to see how they are performing, what are their strategies. It could well happen that the new management is more ambitious, they have a better growth plan, anything could happen. So I'm not going to just make a self decision based on this change, but I'm going to wait and watch. So these are all the situations where we are we should embrace living with uncertainty. So when it comes to stock investing, let me add a few more points. This is not about behaviors. This is about understanding yourself. Let me take a few examples of how I define myself. So by virtue of career responsibilities, I really don't have the time to look at the chart every now and then. I have to travel frequently, and those times I'll not be able to see the quotes. At times I see the quotes only on the weekend. So trading is completely out of scope for me. So I don't know how to handle cyclicals. I don't understand the finance sector because their financial statements are different. So this removes banks, NBFCs, and insurance companies. Do I have the time? No, it's not. It's a luxury, but still, I can manage to spend some time to the extent that I can spend 4 to 5 weeks and make a decision to buy a stock. So I realize the fact I don't have time and I need 6 weeks to make a decision on a stock. I'm fully okay with it. I know my risk appetite. I told you my approach in one of the questions on risk management. And a very, very simple benchmark is what is going to spoil my sleep? That is the most simplest benchmark when it comes to risk management. So doing all such kind of things will solve a lot of clarity related hazels. You need to be brutally honest and stick to a response. Don't succumb for temptations. Can you spare the time for analysis, learning about stocks, monitoring? If no, if the answer is no, then DIY investing is not the right fitment for you. Do you want to trade or invest? That is a very crucial decision. This which decides many other things like the book you are going to read, the person whom you are going to follow, the course you are going to do, everything. So you need to have a very clear clarity whether you are going to trade or invest. I see that many people lack that clarity. They claim to be long-term investors, but hardly hold a stock even for 10 days, and every alternate 2 weeks they are looking for new stock ideas. So that's not the way it should be. You should clearly define yourself. Yes, I am a trader. This is my framework, or this is my trading setup, or I am an investor, or this is my investing framework. That should be very clear actually. A simple example I can tell you. So I was talking with a female colleague who wanted me to help her in her stock investing, and when she was telling about her expectation, what she told was she always wanted her portfolio in green. She cannot see red, and even more stringent requirement was if there are 5 to 10 stocks in the portfolio, all the 10 stocks needs to be green, and that on all the days. So I just tried to explain that it was almost impossible. If she wants to invest in stock markets, she needs to embrace volatility. If that is going to spoil her sleep, better stick with fixed deposits or mutual funds. In case of fixed deposits, she is going to accept the truth that inflation is eating her returns. So know your expectations, your strengths, weakness, and invest accordingly. So over to you, Prince.
Great. So, Venkatesh, we have few questions in the comments, and then we request in the last for a good literature on that. So, shall I, Nareen, you go first with your questions, and then we have one question from Think Investing we will take after Nareen completes.
Hi, Prince. Am I audible?
Yes.
Hello, Venkatesh sir. Thank you for answering my first question. And I got couple of questions actually. Shall I ask both and can you answer, or shall I go one by one?
Mm, I may have a hard stop in a couple of minutes, but let us do one by one.
Oh, okay, okay. So what about what should be the ideal free cash flow yield for a country like India? Because I saw Terry Smith's video on free cash flow yield, and he was telling that he will be comfortable if the yield is above 1% of the expected inflation, and he's comparing that with the long-term treasury bond yields. And for a developed country like US or UK, now it is a huge gap, but usually during the non-inflationary times, the gap might be much lesser. So he is expecting at least 1% yield above the inflation. But for us, like for a country like India, even now the gap is not much bigger, but it's relatively narrower. So what should be the ideal FCF yield for a companies in India?
So really, I don't have an answer for this. I have not ventured nor explored this kind of what is approach. So I don't have an answer for this.
Okay. So the second question, as Prince was talking about the behavioral traits, and I used to follow Charlie Munger and used to have these mental models, a lot of mental models. And what I found difficult was like it's one of the mental models like invert. It's very popular, and the thing when I practically try to implement it, I found it very difficult because the mind usually thinks in a way that what should we do instead of what we shouldn't do, like. So is there any way that you used to follow to apply this practically, or only through practice we can do that?
Venkatesh, are you there? I'm unable to hear you. Am I audible to anyone of you, Venkatesh?
Yes, yes, you are audible. I think
Okay.
connection is
Oh,
bad.
he got dropped for some reason. Let me check. Venkatesh, I have invited you again. Kindly accept. You got dropped again. Okay. Yeah.
Hear me?
Yes, yes, yes. I
Yeah.
can. I can.
Please go on, Aryan. Please go on.
As I was saying, as some of the behavioral traits mentioned by Prince, as Charlie Munger has a lot of mental models. So when I tried to implement it practically, some of the mental models, it was way too difficult than I thought. What is the reason for that? Only through practice we can get that, or is there any some things that we can do to get that quickly? For example, invert is one of the mental models, and when I try to do that, mind used to think that what should we be doing instead of what we shouldn't do. So only when studying about it, in depth and trying to do that manually every time, it is possible to do that. Or is there any easiest way that in your experience you can share?
See, one is academic knowledge, the other one is practical knowledge. So only when you start doing something, you face the real difficulty actually. This is something which goes out of a comfort zone, which is something new for us. So if you are talking about a mental model, whatever you're talking about, I have not personally done that. But when you read and when you implement, they are poles apart actually. And unfortunately, we don't have any people around whom we can discuss so freely and get a response. Like even if you take my case, in case of stock investing, when I started, practically I don't know anybody in my circle who can guide me on this. That's how I turned to all my gurus, whomever I told Mr. Saurabh Mukherjee or Ramdev Agarwal, etc., 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 for their interviews to get some practical insights. So we need some practitioner who can guide us on that. Without that, it's going to be difficult.
Thanks
Thank
for
you.
your question, Naveen. Yeah. So we go with the think invest, and please make sure you ask your question quickly. We are short of time. Yeah. Go ahead. Unmute and ask your question.
Prince, sorry to interrupt. See, friends, I agree
Yep.
that we have a short of time. Any other questions, please feel free to add in the YouTube comments what Prince is going to upload or in the one of the same tweet trails. I'll definitely respond it. Okay. And if I'm not comfortable or if I don't know, I'm frank enough to acknowledge that I don't know or I'm not able to answer it. So even if we are not able to do it in spaces, we'll definitely continue over the tweet chat. Is it okay? Oh, please go on.
Sure. Great. Yeah.
Yeah. Hi. Hello, everyone. Hi, Prince. Hello, Venkatesh, sir.
Hi.
I actually joined in late. Yeah. Hello. So actually, I joined in late. So I'm not sure if it has been covered in some other context. But my question is, what is your strategy? I mean, what would you prefer when it comes to increased competition in any sector? For example, when it comes to gold finance these days, banks are in competition, and sector leader is Method. When it comes to healthcare, Lal Path Lab is, in my opinion, is the sector leader, but there is some competition from other players. In footwear, Relaxo facing some competition heat, and in insurance, HDFC Life is the leader, kind of, in my view, and is facing the heat. So, how do you? I mean, you see these spaces, and how should one find the right player? I mean, how do you completely see the situation? What's your view in such cases?
Okay, you are right. I think you have missed my initial uh, discussion. So I look for industries or sectors where there are less companies so that there is no strong competition between them. So two or three companies, say rating industry, there are two or three companies. But there are exceptions. Even despite being two or three companies, there are tug of war kind of competition like how we see in the telecom industry. So there are exceptions as well, but my preference is to stick for a very few companies, not more than five, so that I'm able to, as a part of competition analysis, I need to refer the other companies' annual report also. So if there are 15 companies, I will be no way able to complete the analysis. So preference is to stick for industries or sub-industries or sectors where there are limited players. So coming to banks, what you told, I also explained that financials are not my strength because I don't understand the way they express their financial statements. Basically, it's a ulta. What we see as assets in other companies, financials put it as liabilities, and it's the other way around. So presently, I'm not comfortable. I need to expand my circle of competence so that I can analyze finance companies. So that way, neither the banks nor the insurance companies or NBFCs have never been in my focus. Good, you talked about Lalpath Industries. They have been competitors. And I also recently finished a detailed analysis of the diagnostic industry where I ask you to please refer to the blogs on diagnostic industry where one blog is completely dedicated for the competition in the industry. To answer in this blog, yes, this industry is of interest because there are only 5 companies and there are n number of unlisted players. 5 companies being Lalpath, Krishna, Thyrocare, Metropolis, and Vijay Diagnostics. But in my analysis, I find they are not truly competing each other. They are into different segments with a minimal overlap. Means Krishna is more into BTG, means the government kind of contracts, and Thyrocare all these years was more into the biochemistry or the preventive maintenance kind of thing. Lalpath and Metropolis more or less have a in different geographies, though different similar business models in different geographies. One of them in the Delhi region, other in the other part of the country. So though they are in the same industry, I don't feel they are in a head-to-head competition. So to understand more of this, I would request you to go through my blog where there is one particular blog where I'm covering even the future competition like the PE money coming and platform players, pharma companies going to launch their own diagnostics, all such things. Okay.
Sure, sir. Thank you. Thank you, Prince. Thank you,
Welcome.
sir.
Welcome. You're welcome.
So Venkatesh, we are almost 2 hours, so I take the last question for today. Any good which you want our attendees to go through, or maybe is on your recommendation list?
Friends, do you have another 5 minutes to bear with me? Because I had one question from my friend, so I would like to, since it was not covered, I would like to just add it. Is it okay?
Sure. I have all the time. You take your time. No issues.
Okay, good, good. So it's about what technicals have a role in my framework. I didn't talk about it. So I'll just talk very briefly about it. Regarding technicals, I fully know about the academic part. I have studied it. I know the different chart patterns, the indicators I can interpret. In fact, 2 years back, I had shared a mind map with all my learnings on technical analysis. However, I'm not a practitioner here. I have not used it in my framework. Yes, there are exceptions. After my decision to buy, I do see the charts to see the if there is any spike in volumes or a price volume action. I do see the charts. And one of my very favorite indicators is the Bollinger Band and all its sister indicators, cousin indicators, I'm sorry, all its cousin indicators, purely because of simplicity, where it gives an indication of the oversold and overbought levels. However, pure buy and sell decisions are not based on these Bollinger Bands. After all this analysis, if I see the Bollinger Bands and feel it is on a oversold region, yes, I postpone my buy for a few days so that it cools out a bit. Such occasions are very rare, but I have done it. So one can argue that you could blend technicals with fundamentals. Yes, true to an extent. My framework has been evolving. That could happen in future. And I know one successful practitioner who is doing this, at least whom I know, who is blending technicals and fundamentals. And if I get a chance to interact with him for a few hours, then I'll have better clarity how to integrate it in my framework. Otherwise, for the moment, technicals are not in a big role in my framework. And for my own understanding, from my own understanding, technical charts and indicators, yes, are also a good way for trading. It's no doubt it's a successful way, but the setup is to be perfect. One should know to exit with trim losses, how long to hold, until what price to hold. All it needs is to properly understand the charts, because sometimes there are false indicators. You should not fall to that. So you should properly understand the charts, closely monitor, and discipline to stick to the trading setup. Because normally what happens is once the breach and the price is breached, you still want to wait for a few more rupees of profit. No, you should have the discipline to cut it down and come out either the loss or profit, whatever. So one of the materials what I recently read was the Here are the technical tutorials. It is well illustrated. If you want to understand technicals, it's a great place to start, where they have discussed the most common chart patterns and indicators. So, Prince, I will take your question on the book literature. So, this already depends on what you know about stock investing. So, I'll just make two categories. So, let us assume that you know absolutely nothing now, but you are determined to do it yourself investing, but you don't know where to start. So, as I emphasized in one of the questions, financial statement analysis is the heart of fundamental statement analysis. I mean, fundamental analysis. If your style of investing is fundamental analysis, you need to understand financial statement analysis. So there are a lot of free academic materials and YouTube channels. My favorites are the financial statement analysis and reporting by Professor Anil K. Sharma. There is a 60-part video. I think you need not go through all the 60 parts. He talks about ratio analysis, like how to interpret ROE, how to interpret the debt equity ratio, all those kind of things. In fact, my depth of financial statement analysis comes from the Professor Anil K. Sharma. I owe a lot to him. So I would strongly recommend that YouTube channel. Next is the Click Finance by Mr. Tim Bennett. So he puts one short video with one ratio, explaining everything about that ratio. And there's a similar structure by Wall Street Mojo. He has both a YouTube channel as well as a website. So as a newbie, I would suggest you to start with this. Somewhere you might feel that these are very difficult to understand, and this is the point where you need to make an important decision. You should seriously reconsider DIY investing and better go for a good mutual fund or a PMS. Why I say this is, if you are choosing long-term investing on a fundamental basis, understanding the financial statement is a bare minimum requirement. So that is definitely required. So the second level, financial forensics. You know everything about financial statements, and you are looking how to find out fraud, how to access management quality, and so on. So then my recommendations would be Diamonds in the Dust by Mr. Saurabh Mukherjee. Please ignore his stock performance or views on a stock. Just see the learning from his book. And there was another gem which I found 2 years back. The book titled is Balance Sheet Decoded by Mr. G.C. Pipara. He is a very famous forensic accountant in our country. He has around put 60 samples or 60 ways by which companies commit fraud and how we could identify from the published financial statements. Naren, you had asked this in Twitter. If you're still there in Spaces, I strongly recommend you to buy this book. So you'll find at least 60 odd ways where companies can commit fraud. Then comes the MOSL, that is the Motilal Oswal Securities Limited Wealth Creation Study, titled December 2019, where it's a thesis or a paper purely on management integrity. They have identified a lot of practices which companies employ for committing fraud. So my take on this financial forensics books is, as you read, make a note of these means of fraud and compile a checklist, because every company does not repeat the same kind of fraud, but there is a pattern. So if you have a checklist, you will be easily able to run through the checklist for the company what you are analyzing. So you say my interest is not on financial forensics, but I want to understand the stock philosophy of different investors. So that way, I would recommend the 2 books of Shri Parag Parikh. One is Stock to Riches and Value Investor and Behavioral Finance. Both are must to read. And Mr. Barasha has written a book of long-term value and wealth creation from equity. It is no longer in print or publication, but soft copy is available in the internet. People can use it. And one should not miss Mr. Basan Maheshwari's book, The Thoughtful Investor. So my take here is, everyone is unique. What works for them may not work for all of us. Sometimes you may not find commonality at all. So pick what best suits you or what you are comfortable with. So you feel that you don't fall in any of these 3 categories. You want to know what the international investors are doing. Then go for the 2 masterpieces by Mr. Benjamin Graham, That is the security analysis and the intelligent investor. And I don't think Warren Buffett has written any book. He has not written any book, but many books have been written about him. And books written by Mary Buffett. There are, I think, 3 or 4 books written where she tries to decode the Warren Buffett style of investing. I think she has done a fair justice relating to what he is holding. So, if you wish to understand what Warren Buffett is doing, the books by Mary Buffett may be a good starting point. I think Buffettology is one book. I don't recall, but if you put Mary Buffett books, you get it on the internet. Then there are a couple of books written by Peter Lynch, Philip Fisher, and Ken Fisher. So this is how all my recommendation would go into. But this is a very good question, friends. I will definitely put all these books names or recommendations in a blog so that people or a wider audience people can find it useful. So over to you, Prince.
That's a great and exhaustive. That is great and exhaustive list, Venkatesh, I must say, and surely appreciate if we get a tweet or a thread on that so that our attendees who missed out on any names can directly refer to that. So, Venkatesh, thank you so much, first of all, for doing this, for agreeing to my request. And I must say, the most structured session I had have so far in my little journey is today's session, and that's really great to listen to your insights shared over a period of time. And surely the attendees who joined somewhere in the between or maybe sometime late, surely they can revisit this session on my handle, or sometime down the line I'll be placing it over my YouTube channel that goes by the name of Accidental Investor Prince. So if you have not already subscribed to it, please subscribe to it so that you can listen to all the recorded podcast at one place, right? So, Venkatesh, thank you so much. So, any closing remarks before we close the session today? And
Yes,
yeah,
yes, Prince. So if you just give me another 2 more minutes. So I really enjoyed this wonderful session with you, and probably this is the first time I have opened up outside my group of my friends in such a depth of my journey. Of course, I and my friends usually connect once in a quarter. I think I got this idea from the book by Guy Spear where he catches up with friends with some learnings, one whatever annual basis or whatever. So similar thing I do with my friends. We catch up and we take up any topics. So people talk on technology related topics, artificial intelligence, whatnot. But I always stick to this topic, and I think in this last few years I have done some 8 to 10 such connects. So beyond that circle, this is the first time I'm talking so much. I truly enjoyed this conversation with you, and I'm also thankful to all the 80 or 90 odd investors who have been patient enough to stay with me for this 2 hours and listening to the space. Wish you all the very best in your investing journey. And Prince, you too, you are doing a great job because I somewhere came for the same diagnostic industry. I told you, right? I put a couple of blogs on diagnostic industry. I was looking for more knowledge. That's when I saw you have done a couple of spaces with Mr. Aditya Kepka, Mr. Dr. Velumani on that sector, which was really insightful to know firsthand from a promoter or a fund manager who knows a lot. So you're doing a really great job. Please continue doing it. My good luck for you as well. Thank you.
thank you so much for your kind words, Venkatesh, and you are doing a great work to everyone around. I saw your work that is very detailed and like nothing ambiguous sort of thing. You write your things with so much clarity and hard work, and please keep doing that. And for our attendees, they can connect with the Twitter handle so that they can have access to his YouTube channel and the blogs which he write after exhaustive hard work and groundwork. So, and that I can vouch for him. Like whatever he writes, he will not write until unless he is 200% sure that he has covered all the aspects in his capacity. So great to have you, Venkatesh, and I feel lucky to have a maiden spaces in this forum with you. So surely sometime down the line when we have something new for our attendees, we'll connect. And thank you for your time. My
Sure,
gratitude.
friends. Thank you for your time. Good luck to all of you. Have a great weekend.
Great. So good night, guys. We connect soon for another spaces with another expert. So till the time, keep showering your love and keep learning. And please do not try to copy simply by listening the names. Try to see the framework of people and try to see if it fits in your framework. Don't try to blindly clone anyone because that is not going to help you anyway. So with this, I take your leave. Good night. Take care.
Good night, everybody. Bye.